Hey guys, welcome back to a brand new video. I'm RexFinance, and it has finally happened. People are finally calling for a Great Depression. The Great Depression of 2022, the Great Depression 2.0. Yes, in relation to the Great Depression that happened during the 1930s, also known as the Dirty 30s. People think that that is what is in store for our future. I'm honestly surprised it's taken people this long to start drawing conclusions and making connections to 1929 and the 1930s and relating that to the current stock market and the current economy, because this has been a very, very rough year. One individual in particular, whom I both follow and respect greatly, has put out an opinion on Twitter today that he thinks we're in for a 30-plus year bear market. He thinks that 90% of the wealth that is currently in the stock market is going to be erased over the coming 30 or more years. And in case you somehow miss his point, he even takes the time out of his day to take a picture of the Dow Jones Industrial Average and draw an arrow pointing to the ground on it. I mean, if that doesn't paint you a clear picture of what he thinks is going to happen, I don't know what will. But the scary thing about all of this and all of these people claiming that they think another Great Depression is upon us is that it's actually somewhat merited, this fear of the Great Depression. Just look at the stock market, for example. The S&P 500 is down 23.3% in the first 184 trading days of 2022, the fourth worst start to a year in history. And we're only ahead of 1931 by around 6.3%. So the stock market is even telling us itself that something was very, very wrong in 2020 and 2021. And it's telling us that there's at least a remote possibility that this could be very eerily similar to the Great Depression of the 1930s. Now, if you're not already scared enough about the current situation, just look at mortgage rates. The 30-year fixed mortgage rate is 7.644%. That is extremely high, and it's a number we have not seen since 2007, when we had a huge recession in the economy. And this is a huge deal, not only because of the number here, but also because of the effects this is going to have on the housing market. And, if you invest in the stock market, you felt it with me. There's something called the wealth effect. Think back to 2020 and early 2021 if you were investing at that time. All of our portfolios were skyrocketing. My personal portfolio was over $200,000, and at the time, I was a 19-year-old kid. 2 years later, obviously, I'm 21 and I'm a regular broke college student. But in 2021, when I was the most wealthy I have ever been, I decided to go purchase a Tesla Model 3. And I'm glad I did so. I locked in a loan for just over 3% to purchase that vehicle. So we had a very, very profitable stock market. We also had very, very favorable interest rates that just propelled the economy to new highs and new highs and new highs, and everybody was spending money. Everybody had a high propensity to spend and invest their money, because why would you save money if you're going to double your money in the stock market in a single week? Fast forward to today, and the opposite is true. I'm a regular 21-year-old broke college kid again. Things have been reset. Lots of stocks in the stock market that were up 300, 400, even over 1,000% in early 2021 have now erased 80 to 90% of those gains. Most of our stock market portfolios have absolutely cratered. But the even scarier thing here is that the real estate market perhaps even has a greater impact on this wealth effect. And up until recently, the housing market has stayed very, very strong. Home prices kept increasing, which obviously increases individuals' and families' wealth. And if their wealth is in a good place, obviously they're going to spend and invest money, which is maybe the reason why we haven't seen consumer spending slow down, because home values have stayed very, very high. But recently, because of these extremely high interest rates here, the housing market has started to tip over. And this can get really scary, especially if this impacts the wealth effect more than the stock market already has. Not even to mention the fact that you can get a risk-free return in treasuries of over 4% right now. Not spectacular, but you know what? In a stock market that is very, very grim, and where there's lots and lots of uncertainty and doubt and fear about our economy's future, 4% risk-free is very, very enticing, especially if you're a retiree or you're about to retire. Over the past year, lots of people's retirement funds and portfolios have lost tons and tons of value. So a 4% risk-free return on a 2-year treasury yield is very enticing to those people. So if you can get over 4% risk-free, why would you put your money in the stock market when it is so uncertain right now? So obviously there's a lot in the economy to be a little bit skittish on, uncertain about, doubtful, fearful on, you name it. There's a lot of stuff out there we can point to. But the issue with all of these things, especially the people claiming that we're going to have another Great Depression, perhaps worse than the 1930s, is that they're not even looking at the economy like I just did. Most of those people, if not all of the people predicting a Great Depression, are strictly self-proclaimed technical analysts, saying that it looks like the stock market's about to roll over, and if we break these lines, and if the stock market follows my arrow that I just drew on this chart all the way to the ground, we're going to have a stock market depression. These technical analysts ignore everything to do with the economy, and they simply compare charts that fit their narrative and draw arrows and lines on charts that also fit their narrative. For example, let me show you this picture on the screen right now. These technical analysts are so quick to show these two graphs that I'm showing right now on the screen because it fits their narrative. A 91% correlation comparing the current SPX to the SPX in 2008. And an 85% correlation comparing today's SPX to the 1973 SPX. Both of these fit their narrative that they think prices in the stock market are going to fall hard. However, they choose to ignore these two new charts that I've placed on the screen now because it doesn't fit their narrative. We can look at the SPX in 1962, 90% correlation to the current SPX, and see based on this chart that the stock market should go way higher from here over the short term. Or an 86% correlation to the SPX in 2015, we could see that the stock market should go way up over the short term. So I guess what I'm saying here is we cannot rely solely on technical analysis to tell us what the long-term future of the stock market is going to hold. Technical analysis can be very helpful over the short term, but there are way too many market powers and dynamics at play that technical analysis just is not accurate over the long term. And the bottom line is you can find technical analysis to fit whatever narrative you have. If you are long on the stock market, there is plenty of technical analysis out there to tell you the stock market's going to go up from here. But because the bear market thesis is so dang popular today, people are only paying attention to that technical analysis that is telling us the stock market is going to fall from here. The only technical analysis that has worked over the long term is if you take the all-time chart of the stock market, then go to the blockchain backer's tweet and take this arrow he put on his chart here, reverse it and go back to this chart and place that arrow going up in a straight line. That is the only technical analysis we have that has been proven true and works over the long term. Even going back to 1929 and the 1930s when the stock market crashed, guess what? Over the long term, the stock market went up in a straight line. There is a reason that all of the self-proclaimed technical analysts have to put out new TA every single day. It's because they're wrong every single day, and their previous TA is always proven incorrect. Now, don't get me wrong. As I already acknowledged earlier in this video, TA in the short term, technical analysis in the short term can be very, very useful and helpful. It can be very, very correct. But trying to predict the long term and predicting a Great Depression based on technical analysis is just stupid in my opinion. So now if you're wondering what I think is going to happen, I don't think a Great Depression is upon us. I don't think we're going to have a bear market for 20 to 30 or more years. I don't think that's possible. I really don't. And for starters, one of the reasons I don't think we're going to have a repeat of the 1930s is because the average forward PE valuation of the S&P 500 is sitting at 15.6 right now. In 1929, guess what that number was? It was 33. More than double the current forward PE valuation on the S&P 500 today. There is no exuberance in the stock market right now. Valuations are not out of whack right now like they were in 1929 before the stock market crashed. And so if you think we're going to have a Great Depression, it simply cannot be based on technical analysis, and it cannot be based on the fact you think we're in a bubble, because based off of any valuation metric you use, we are not in a bubble right now. Which leaves us the economy, which I discussed at the beginning of this video. There's lots to be fearful about, doubtful about, uncertain about in the economy today. But what do I think is going to happen to the economy? I don't think it's going to stay in a bad place. I don't think it's going to stay in a fearful, doubtful, and uncertain place. I think we're near the bottom here with the economy. I continue to see very strong employment data. To get a depression, we would need far more workers than there were jobs available. We're in the exact opposite situation right now. We have way too many jobs and not enough workers to fill them. That is not lining up to have another Great Depression. I also see inflation cooling off, albeit slowly, but I don't see inflation continuing to rocket up higher and higher. And as a result of that, I think interest rates are going to peak within the next 3 or 4 months. Now, yes, we have an idiotic Fed right now. We have a Fed that did not tighten soon enough when we saw commodity prices absolutely skyrocketing. Commodity prices are the best leading indicator we have for inflation. And when commodity prices skyrocketed, the Fed was still loosening monetary policy. And right now, if you haven't noticed, commodity prices have fallen significantly, and I think they're going to continue to do that. And the Fed is still tightening. It makes no sense. We have an idiotic Fed at the helm right now, but with interest rates that are likely to settle between 4.5% and 5% at their peak, that's simply not enough that the Fed could cause a 20 to 30 or more year Great Depression. If interest rates average 4%, that is still extremely accommodative to any economy after the economy adjusts to that interest rate. That's the reason we felt so much pain. The economy needs to adjust when interest rates go up. But after the economy is done adjusting, a 4% federal funds rate is still very accommodative to a growing economy. We also have a stock market sentiment in the trash right now. And typically, the market in the economy ends up bottoming when sentiment is in the trash. I would even argue that sentiment is near as bad as it was during the COVID-19 lows in the stock market. Financial advisors and YouTubers alike are getting mutilated if they are long on the stock market and in this economy by their clients and their viewers. There's also the fact that yesterday, only 3% of stocks in the S&P 500 closed above their 50-day moving average, a reading more oversold than 99% of historical data points. This is part of the reason that I expect a short-term rally in the stock market. We are also sitting right at a double bottom in relation to the June lows we set in the stock market. How's that for technical analysis? But there are so many people out there that are just going to buy simply on the fact that we are at a double bottom, or the hope that we are at a double bottom, the stock market's going to rocket from here. Now, I'll say this. It's possible, if not likely, that the stock market will have a rally of 10 to 15%, but then fall back down and break below these June lows and these September lows. It's extremely possible that'll happen, especially if we get CPI data that is very unfavorable. I personally expect the NASDAQ to have a 10 to 15% rally before October 13th when the next round of CPI data is released. At that point, based on the numbers we get out of that CPI release, the stock market's either going to continue its trek upwards or we're going to fall right back down to new lows. There's no in between. So let me know down in the comment section below whether you think a Great Depression is upon us or not. Obviously, at this point in the video, you know my personal feelings and opinions on it. Also, if you enjoyed this content in this video, please hit that like button down below. It helps me out tremendously. And also, don't forget to subscribe if you are new here or returning and not yet subscribed. I love seeing all the new faces come join my channel. With that, have a great rest of your day. Stay blessed. Keep your chin up. Peace out.